The US economy remains robust, with GDP growth between 2.5% and 3% and strong employment figures. However, a slight uptick in inflation may lead the Federal Reserve to slow the pace of anticipated rate cuts. This sustained economic strength has propelled the US stock market to a second consecutive year of solid performance. US earnings yields relative has come also at par with bond yields, first time since 2002. Furthermore, S&P 500 is trading at almost 1.8x standard deviation higher than its 10-year average forward PE. While the US accounts for roughly 70% of global market capitalization, its GDP contribution is only around 25 to 26%. This concentration further amplified as top 10 stocks market cap to total S&P 500 market cap is at historic high. After significant FII selling in October, net outflows slowed in November, with December showing a positive trend. This reflects a cautious but improving sentiment among foreign investors regarding Indian equities. The Q2 FY25 GDP growth, YOY, came in at 5.4%, lowest in the last 7 quarters, mainly led by lower government spending and slower capex. GDP data is a lagging indicator as it is released after 2 months. Corporate earnings provide a more timely reflection of economic trends, as seen in the past as well. Despite recent slower growth, India remains a country with strong and much more stable growth economy. Economic momentum is expected to recover in H2 FY25, driven by a rebound in government capex post-elections, recovery in rural consumption, and on the back of festive season demand. Various high-frequency indicators are also hinting towards the uptick in the economy. FY23 earnings were driven by revenue growth, while FY24 was more about margin expansion. With margins being at higher end of historical range, top-line growth should lead the earning going forward. The Nifty 50 share of total market capitalization has decreased from 55% to approximately 45%, while the concentration within the Nifty's top 10 constituents has fallen from roughly 35% to around 20%. The temperature gauge index remains in the fair value zone. Equity markets now are in consolidation phase after a corrective phase of 10 to 12% in the benchmark indices. While corporate earnings had hinted towards the slowdown, GDP growth numbers confirmed that. However, Indian economy continues to remain on strong footing and signs are visible for growth coming back on track gradually. Hence we continue to remain positive on the equity markets from long-term perspective. However, in the short run, given the uncertainties in the global context like the geopolitical situation, central bank policies, and rich domestic valuations, Indian equities may face concerns. It is advisable to tread with caution by adopting a strategy which is balanced and resilient. Based on their risk profile, investors having the appropriate level of equity allocation can continue to remain invested. Considering the recent corrections, if equity allocation is lower than desired levels, investors can increase allocation by implementing a lump sum investment strategy for hybrid, large and flexi-cap strategies, and 3 to 6 months for select mid and small cap strategies with accelerated deployment in the event of a meaningful correction. Since October 2023, we have observed a downward shift in the yield curve, driven by favorable demand-supply dynamics, well-contained inflation, and stable domestic macroeconomic conditions. However, over the past 2 months, a confluence of global and domestic factors has introduced some volatility, pushing yields higher. With the evolving interest rate scenario, the fixed income portfolio should be overweight on accrual strategies and neutral on duration strategies. With regards to duration, since majority of easing of the yields in 10-year GSEC has played out from 7.35% in October 2023 to 6.75% in December 2024, we believe only the last leg is left in terms of easing of yields, which can be played through longer maturity GSEC bonds or funds, albeit interim volatility. 15% to 20% of the portfolio may be invested in actively managed duration funds or long-term, 15 to 30 years average maturity, GSEC papers or funds. Accrual can be played across the credit spectrum by allocating 40% to 50% of the portfolio to performing credit and private credit strategies. In VEETs and select NCDs, 25% to 35% may be invested in performing credit strategies, NCDs, and in VEETs. 15% to 20% may be invested in private credit including real estate infrastructure strategies and select NCDs. 15% to 20% of the portfolio may be invested in arbitrage funds, minimum 3 months holding period, floating rate funds, 9 to 12 months holding period, absolute return long or short strategies, minimum 12 to 15 months holding period. For tax-efficient fixed income alternative solutions, 20% to 25% of the portfolio may be allocated in conservative equity savings funds, minimum 3 years holding period.